Foreign portfolio investors, considered the movers and shakers of equity markets across the globe, seem to be going slow on India. NSDL data suggest that they have put in a net 55,691 crore rupees in the Indian equity markets so far this calendar year. By comparison, they had invested 1,70,262 crore rupees in calendar year 2020 and 1,01,122 crore rupees in calendar year 2019. Their investment on a financial year basis reveals an even more startling picture. In FY22 till 8th of September, they had pulled 52 crore rupees out of the Indian equity markets, compared to a net investment of 2,74,032 crore rupees in FY21 and 6,153 crore rupees in FY19. Over the next few months, most analysts believe foreign flows into the Indian equities will depend on a possible third wave of COVID, US fiscal and monetary policy decisions, and China's regulatory scrutiny and macroeconomic adjustment. Another key concern has been the new T+1 settlement cycle proposed by Sebi.
See, I think it will evolve in the sense that not passing any judgment at this point in time, because more so, I think it is more of a logistical issue rather than, see, from the intent perspective, it is good. Okay.
Okay.
My sense is basically that it needs to marry or get harmonized with the logistical issues, and the infrastructure as well. Right. So from an FPI perspective, right, what I understand is basically it will take some amount of effort to get the infra in place, and it will be an additional cost as well. So those are the things which will probably have to be kind of aligned to, is what my view would be.
Okay, but otherwise you're positive on the view,
as I said,
on the development.
Yeah, the intent is
is right.
Is right, but as I said, one has to be practical as well in terms of understanding one has to be cognizant of understanding the practical difficulties as well.
UR Bhatt, co-founder and director Alphanity Fintech, also shares a similar view as Shangvi and suggests that there will be huge logistical issues while implementing this. Shayon Mukherjee, Managing Director and Head of Equity Research for India at Nomura, said that investors should brace for some volatility as flows adjust to these global events.
The reason is not India, but it is because of the overall emerging market basket and largely affected by China and Chinese, regulatory moves over the internet companies and technology companies. We are in fact seeing some amount of balancing towards India, thereby actually, having an incremental share into the emerging market basket, right? At the same time, what we also need to understand is basically the IPO market or the primary market remains pretty robust in terms of the inflows which we are seeing from the FPIs. Okay. So I wouldn't say that it's out of flavor, but I think the only thing I would say is basically it is more from a global perspective. In fact, India's market valuation as a premium to overall emerging market is kind of expanding.
What are the key factors they will keep in mind before investing in India for the next 6 months?
See, I think, as you rightly mentioned, one, that I don't think there is first anything to worry about from an FPI perspective towards India. In fact, the growth and the commentary on the corporate earnings from the managements have been pretty robust. So I think there is some good, decent comfort out there from that perspective. At the same time, the high frequency data on the economic growth is also looking pretty robust. So from that perspective, I'm not kind of too worried about. With the second question in terms of in the coming 6 months, my sense is basically that it would lot depend on how the global markets pan out. There is a huge debate about inflation versus growth,
Correct.
and the effect of that onto the tapered or the quantitative easing programs kind of tapered down, on to the likely impact of the interest rates as well.
Correct.
So a lot of these variables, I think we will come to know in the coming few months. Thereby, my sense is basically that there can be a period of some amount of volatility,
Okay.
before we kind of resume the uptrend which we have been seeing.
Okay.
The underlying fact being that economies are recovering,
Okay.
and corporate earnings outlook is also pretty steady.
Correct.
Will developed markets be able to score over their emerging market peers?
See, honestly, I mean, I wouldn't want to play a DM versus EM trade purely because DM at this point in time, are doing pretty good, right? And the sense that their earnings outlook is pretty strong, their economy is doing well. So, as an investor, right, I would not be kind of looking at a DM versus EM trade. Of course, if I have allocations to EM market, I'll continue my allocations. May I be rebalancing those kind of allocations in favor of India, which we have been seeing.
Okay.
But DM definitely are in a driver's seat at this point in time, where the economy is recovering, and we are seeing some robust numbers out there. Unless again, the fresh round of COVID virus comes about,
Correct.
and you may see any other event which might get impacted in terms of their robust economic outlook.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.